Hey folks, it's Rob Flux here with another Sunday session, and today we're going to be talking all about property hotspots, which is absolutely everybody's favorite topic. Where is the next thing actually happening? But today we're going to do it with a little bit of point of difference. We're going to have a competitive showdown between an investor and a developer. And so in order to help me to have the fight, I'm going to bring across a good friend of mine, Nero, from Investment Rise, and I guess Nero, a buyer's agent. I guess in the property investment space, mate, we're gonna be duking it out to go investor versus developer.
Looking forward to it, Rob. And look, thank you so much for having me on.
Mate, more than welcome. Firstly, before we get into, I guess, the fight, let's tell us a little bit about who is Nero, who is Investment Rise, what do you guys do, and why are you, I guess, the guy I should be fighting with today?
Oh, well, Rob, look, I've been someone who's now been investing for 23 odd years now in property, bought and sold properties all around the country. I wish I could have told you every property I bought was a success. It wasn't. I've definitely made some mistakes along the way that I've learned from, but I'm lucky enough to say I've got incredible financial certainty in life because of property. And along the way, as I started to achieve some results, friends and family started asking me how to help them, and I did, and I enjoyed that. And so as a result, I decided to see if I could, do this full time. And I opened up Investment Rise in 2016 as and it's been a buyer's agency, and we're helping clients buy in all the right areas at the moment. And it's been something very rewarding to be able to help people and really sort of transform their lives from a financial perspective. Because a lot of people can get it wrong when it comes to property.
Absolutely, and one, I'm clearly saying tongue in cheek that we're actually going to fight.
Yes.
I want to call it out, everyone, folks. I had 20 years of buy and hold investing before going into the property development space. 17 years as a developer, so 37 years in the property space. Bought my first house at 18, Nero.
Jeez. Wow.
Correct.
I was 22 when I did mine, so you're beating me to the punch.
Well, my first investment property was 21. And owned my first house outright at 24.
Wow.
So, I was doing okay.
Amazing.
But
yes, you were.
2 divorces and not quite the same anymore. Put a lot of toys back in the kitty, and so what we're going to talk about is, I guess, some of my lessons along the way, some of your lessons along the way. I guess differences in philosophies. I want to make it really, really clear, folks. Both strategies work. There is no right or wrong. There is what suits you. They just work differently. And the thing that I'm going to say to everyone is to say everything works, but only if you're good at it, right? And so if you want to be an investor, I'm fine with you being an investor, but get good at it. If you want to be a developer, that's great, but get good at it. And if you do that and you do the right things, and we're going to try and help you with some of those things, then everyone should actually, work along the way.
Exactly.
Now, I might start with just a general statement that is, there are really 4 reasons to invest in property, folks. So 2 of them are in Nero's world, in the investment space. One of them is in my world, in the property development space, and one of them is with absolutely every single one of you out there. So firstly, lifestyle. Lifestyle has absolutely nothing to do with living, making money. It's everything to do with being located close to work, close to transport, close to shops, where the kids are going to school, all those sorts of things. And if you make money as a byproduct of that, that's good luck to you. But we're choosing that really for, the creativity that or the flexibility of our lifestyle. Okay. The other 3 reasons are for making money. So capital gains, capital growth is very squarely in your space, Nero. Cash flow, also very squarely in your space. And then my space, property development, is manufactured profits. Okay. Now, where I try to teach my people, my community, is that there's actually flexibility in both. Okay. So what we both want in the end is the cash flow, because we can't eat an asset. Okay.
No.
So what we're trying to get to is a cash flow positive property. The question is, how do we get there? Okay. And so that's really our differences in philosophy, is how do we actually get to that cash flow side of things. So
Yep.
with that said, I guess out of those two,
Yeah.
in your world, do you go straight for the capital growth or do you go straight for the cash flow? What's your take on that?
Yeah, definitely. Talking about investing in Australia solely, it would be capital growth first and foremost. The cash flow is really the vehicle to get us there, but capital growth is the key thing that we're after. That's the outcome that we want. And
Okay,
so for us, it's really about saying, where do we buy, but making sure what's your cash flow going to be like? Can you handle this property during at least the first few years?
yeah. So if we're aiming for a capital growth type perspective, then I guess again, general statement out to the masses. If you're investing for capital growth, the high level strategy here is that you collect as many properties as humanly possible. I guess within the serviceability you can fund, you hold them for enough time for them to go up in value that you can sell a couple of them down and pay down the debt of the ones that are left over. And if you do that, the ones that are left owned outright are now very, very positively geared, right?
Yeah.
Now,
Yep.
if you're doing that type of approach, that's a 10+ year horizon. Is that right, mate?
Yeah, absolutely. You're looking for 10 to 15 years sort of horizon really. So if someone's starting at the age of 50, you're starting now because you may have 15 years to 65 to retire, but you don't have 15 years to get started. You need to get started now and let time work in your favor. So you are relying on, yes, location, everything else, but time is really your biggest thing here to achieve your goals.
Yeah, and we're going to talk about, I guess, both time in the market and timing the market, I guess, a little bit
That's right.
later. But we just kind
Yes.
of put that as a pin drop for now. So given that's the approach, if you've got 10 to 15 years, I guess then it would be sell down a couple. If you've got
Yes.
longer, right? If you've
Yes.
got 20 to 30 years, because you're starting very, very early, do you have to be selling down?
Look, no, you actually don't, because over time, given enough time, you're going to see rents rise. Your loans are going to switch over from maybe interest only initially to principal and interest. And done correctly, you might be in a position where you don't need to sell if you bought the right properties along the way, because they end up giving you neutral to positive cash flow just because you've got more time. You've got to remember the average loan is what in Australia, 25 or 30 years. So if you have that time period up your sleeve for a property, you could have it paid down much faster than that and not have to sell them down. So definitely those who start earlier have the advantage. What's the old adage, Rob? The best time to buy a property was 10 years ago. The second best time is today,
Now.
right?
Is now. Yeah.
Yep, is now, exactly. there's that's really there's never been a truer statement. And I would say many people say, wish I'd bought earlier. I'm like, yes, but don't be saying that in 10 years time from today.
Yeah, correct. So the biggest thing that I would say for anyone is take action. Whatever your investment strategy is, whether it's property development, I guess investing, take
Yes.
action. There's
Absolutely.
no point thinking about it. Thinking the thing is not doing the thing.
No. Waiting for the perfect time or waiting for all the lights to go green before you start your journey, you are probably just going to end up missing the entire boat, really.
Yeah. Okay. So we're talking from a timeline horizon, 10 to 15 years if you're going to sell down, 25 to 30 years if you're intending to hold everything. And that approach, I guess, lets inflation erode the debt. Now, as inflation goes up, wages go up, rents go up, but the debt is always the same size loan, other than you're paying it down slowly. And so I guess that gives you the flexibility of letting time pay that off. Now, property developers, we have a different approach. We're in a little bit more of a hurry, mate.
Yes, you are.
We're in a little bit more of a hurry. We're manufacturing our profits. And because the fact that we're manufacturing our profits, depending upon the kind of deal that we're doing, it could be as little as 3 months, or it could be 2 to 3 years, I guess, before we actually, between starting a project and payday. But we're looking to get in and out of deals as quick as we can. We're trying to force value on and get out of Dodge. And we're trying to limit our exposure to the market in a predictable cycle. Okay. Whereas when you're holding it for as long as you're going to go through many cycles. And in going through many cycles, that can be a hairy ride as you watch markets go down. But you don't lose money unless you sell. Is that correct?
Look, correct. And I think one of the big things that we're starting to see with the Australian property market is we're no longer a boom and bust market. I think, and especially if we talk about some of the fundamentals a bit later on, Rob, what we all see is that this is Australia's a property market on a macro level anyway, where it's essentially a rising market with a few dips along the way, almost like the ocean going back in before it comes back onto shore sort of scenario. Essentially, it's a property market that in most locations are going to just keep rising in value over time. Yes, there will be some corrections, as we have seen in certain markets over the last sort of 18 months anyway. So yes, you've just got to understand that if that's your strategy, long-term strategy, you've just got to be prepared for that. It's all about going into whichever pathway that you choose to create wealth with property, understanding how they work and be prepared for it.
Yeah. Now, I just touched on you don't lose money unless you sell. But what happens when you pick a dud and it's underperforming? How often should you be, I guess, assessing the performance of a property you've already bought?
Look, I'm big on assessing your properties at least once a year to see what's going on. You need to know, is it rising in value? Is it set to keep rising in value? Has the market you bought, has it gone flat? Because I think a lot of people will make a mistake of buying an asset, or what the hope is an asset, a property to rise in value, being the goal being capital growth. And then when the property doesn't perform as what they planned, or what the capital growth was that they were hoping for, they then just keep holding, hoping and praying that things will change. Now, hoping and praying when it comes to creating wealth through property is probably the worst thing you could do. You need to have a sense of what's going on. Now, for example, if you bought, say, in Townsville before the mad rush that started, maybe 4 or 5 years ago, if you were a couple of years early to the party, you saw that the fundamentals were still strong, you would hold, of course, and you would have done very, very well. But on the flip side, if you've gone and bought, I don't know, a 2-bedroom unit in Parramatta or Westmead and didn't rise in value from 2017 to 2024, the odds are long-term you're not going to see a lot of growth. There may be a slight blip upwards over certain times, but you're not going to see the growth because the underlying supply and demand fundamentals aren't there. So I'm a big believer in constantly reevaluating your portfolio, being across what the changes are in the markets that you bought in, and then saying, hey, is this thing still the right thing for me to hold on to for my portfolio?
I would agree with that. I guess my slight nuance to that is I look at my properties a little bit more regularly than that. I tend to look at them every couple of months. I recognize that markets go through cycles, and there are times when I guess that cycle is working in my favor, and there's times when it's not working in my favor. And generally, a cycle from an investment perspective takes 7 to 10 years to run. But generally, it's only 18 months to 2 years where it's actually growing. And so you've got, 7 to 8 years where it is flat or going slightly backwards. So I'm looking for, when is the tide starting to turn on that? And is it appropriate, or is it timing wise for me? Can I repurpose my cash? Right.
Yeah.
So I'm wanting my cash to be working hard.
Yes.
Now, whether we do it every 2 months, whether we do it once a year, the key point is you should be reviewing it regularly. Okay.
Yes, absolutely.
Now, the 3 questions that I want everyone to kind of get your pencils out and kind of write down, the 3 questions that you should be asking yourself. Firstly, out of the 4 reasons to buy a property, you should be very, very clear on why you bought it. Okay. So before you even ask yourself these questions, So if your intention was for capital growth, for example, then your question is it performing as intended?
Yes.
If your intention was for cash flow, is it performing as intended? So you want to understand what your purpose was and is it performing? So then you can go, yes, no, I'm very clear on where I'm sitting. Now, it's easy to get ourselves into a false sense of, security on that because, hey, the market has gone up, but perhaps it hasn't gone up as much as the rest of Australia. Oh, yeah, I made 100K, but the rest of Australia made 300K, right? So, yeah, I've made capital growth, but you want to be comparing that against the Australian average and saying, is this underperforming versus what everything else is doing?
Yeah, couldn't agree with that more. You've got to be comparing it to something, and it's not just are you losing money, but is this the best possible return on your cash equity, however you decide to structure yourself?
Yeah. Second question, what is the likelihood it's going to continue to perform? Now, noting the cycles and that they go up and down, am I coming to the end of the cycle? Is it the end of the run? And so am I coming into a flat period, for example, or even a negative period? And I'm looking at a whole bunch of things that we're going to touch on in a sec, which is what are the drivers that are driving that particular market and the like. And then lastly, whatever the answer is on those first two questions, my last question is, with what I know now, because I'm a smarter dude today than I was yesterday, with what I know now, can I do better with the money? Right?
Yep.
And so depending upon how you answer that, there's, I guess, a whole bunch of permutations, but it could be, yes, it's performing well. Yes, it's going to continue to perform well. And no, I'm not very smart. So I'm clearly going to leave it there. Right? Yes, it's performing well. Yes, it's going to continue to perform well. But hey, I've just gone and learnt this new strategy and this new thing, and I can see this new growth area that's going double the right. I might reconsider that. Okay. No, it's performing bad. No, it's never going to come good. Blind Freddy could do better than this. Then lose a finger rather than lose an arm. Right? But you've got to be asking yourself those questions regularly and consistently to know if and when I should pull the trigger on that.
Absolutely. And as I said, my journey hasn't always been perfect. I've made some mistakes. So yeah, I've bought a couple of dud investments and selling them always feels painful. But what I can tell you is after you've got rid of it, the improvement in cash flow, the improvement in your ability to sleep, knowing that you don't have something that's really sucking money out of your account every single week, month, whatever it is, that is fantastic. And you can then really rebuild from there. So I'm someone who's had to rebuild my portfolio a couple of times, especially with some of the mistakes I made early on. So if anyone's thinking, I've got this property, it is just never going to perform, but I'm too scared to sell it, I can tell you that I've been there, and I'm glad that I sold the ones that I sold. I've got no regrets about selling any duds whatsoever.
No.
It's definitely, freed me up to move forwards.
Yeah. And clearly, folks, not advice. You need to be talking to your accountant and your financial planner with regards to, the timing of these things, and
yes,
the implications from a tax perspective and that sort of thing. But if it's actually taken a hit, it could actually be a tax advantage to you as opposed to a disadvantage. Now, there might be some cash implications on that, but as I said before, it's better to lose a finger than lose an arm. And so we need to be looking at, well, is it slowly eating itself away? And I'm going to lose the arm anyway if I don't do something about it. I'd much rather the Band-Aid.
Yep, absolutely.
Okay, so fairly similar in, I guess, our approaches on both of those things. So far it's kind of 1-1.
Yeah, exactly. No king hits yet. Okay.
Okay. But I guess because we take this much shorter view on things, and we're in and out of markets super fast.
Yeah.
We need to be, I guess, looking at the timing of the market super critically. Okay, so if I'm buying into a falling market, I've got to consider how long is my project going to take to run, and by the time my project finishes, will it have kept falling, or will the market have potentially turned around by that point in time? And so I'm looking at a 2+ year horizon to say, well, I'm selling into the future. What does that actually look like? So I'm always looking well in advance of today, knowing that my projects are going to run. Now, I'll say that my record of a project is 6 weeks, right? So, I didn't have to look that far into the future.
Okay.
But a typical project is going to be anywhere from 12 months to, I'm going to say, 2 years, depending upon what you're actually trying to do. So we've always got to be conscious of where we are in the cycle. Are you guys conscious of where you are in the cycle as well?
Look, absolutely, because if you're looking to invest in property and you especially want to build a portfolio, one of the key constraints is going to be, how do you keep finding the deposits for the next property, right? And so we want to see, well, are we buying a property that has the strongest chance of being worth significantly more in 12 months, 24 months, 36 months, whenever you are thinking of buying property number 2? So our key thing is we want to make sure that every property is a stepping stone to the next one. And so therefore we are looking to see, well, where are we in the cycle? Because if it's a falling market, there is less than a 10%, maybe less than a 1% chance we're going to go there for most of our clients. It just doesn't make a lot of sense. But if it's flat and then things are looking like they're going to go, then maybe we're at the start of a cycle. Are we midway into a cycle? Or are we at the end of a cycle when there's a lot of froth and bubble and everything else, but the underlying fundamentals show that, this thing may now come off the boil, slow down? Because the thing with that is, if we buy a property there, it may be good for the next couple of months, but 12 months down the track, you found, this actually hasn't grown very much. And then the opportunity cost, because you can't buy that property number 2. And that's the key thing here, is when you're building a portfolio, understand that every property, the way we like to structure it, has to be a stepping stone. If we get this one wrong, even though it might rise in value, if you get that wrong, you can't keep going forwards. And especially if you've got a 10-year goal and you now lose 3 years, you've probably lost a chunk of time that you're not going to have enough time afterwards to recover from. That's, I think, the biggest thing that a lot of people don't realize when they're building a portfolio, Rob.
Yeah. And I guess so I guess we're looking at the same things, but we're probably trying to pick different times of the market cycle to actually get into.
Absolutely.
You're looking at trying to get in as close or near to the bottom of the market humanly possible. I'm looking at, I guess, being counter-cyclical and going, I'm looking at falling markets going, this market is going to turn at some point, right? If I can buy when people are I guess, where things are crashing, I might get some really super creative terms with regards to, I guess, the deal that I actually manufacture. And I know that the market is going to turn and flip the other way and pop out the other side. The tricky part is trying to convince the bank that that deal's
absolutely, that is a tricky part. But on the flip side, it's not a serviceability issue though for you when you're doing it, right?
Majority of the time, no. And I think this is a big misconception in the property development world, is I can't get into deals because of my lack of serviceability. Okay. Now, a lot of people try to do residential lending, I guess, because it's, I guess, a relatively cheap interest rate, and we've been indoctrinated into that process. But when you actually understand that we are forcing value onto the property and the timeline is very, very short, it opens up a myriad of alternative funding models to you that most people don't have access to when they have to prove that they can hold it for 20 or 30 years. Okay. So we have 8 different ways, count them, 8 different ways that we can manufacture profits out of a property by controlling it and not necessarily owning it. Okay. So if I don't have to own it, I may not need the deposit. I may not need the serviceability, right? I might just need the liquid cash to run it. Now, that's not it. Every one of those 8 deals doesn't solve that problem, but some do, and sometimes we have to stitch a couple of them together to get creative outcomes in doing things. But by being able to force value onto the property and the relatively short timeline, people are willing to be flexible to go, how do we make the deal happen? Right? So my general comment to people: don't let your lack of resources stop you from being resourceful. Okay. So the question is, how do I make that happen? And there are ways where we could work with the landowner. Well, they've owned it for 20 or 30 years. They owe nothing on it. Their holding costs are nothing. Do I do a profit split with them? Right. Do I buy it off them at a future point in time and pay more for the property in the future, but I'm basically just passing back the holding costs that I would have paid if I paid today? Right. So little things like that. And there's lots of different creative ways to do that. So they get more money. We get a better cash flow situation, and we don't have to fund it today, but we're able to add value to it today. So there's lots of different ways that we can actually solve those problems. But you don't get that flexibility when you're holding it for 20 or 30 years or 10 plus years. Yeah.
No.
The bank says,
definitely not.
prove you can afford that.
Yes. And it's as creative as there are some lending options out there today for clients to kind of get that 4th or 5th property, whatever the case happens to be. There is still a limitation. There is still a constraint, right? It's either going to be your income, it's going to be your debt to debt ratio, whatever happens to be the case. There are going to be certain constraints because it's all based on you, right, as the individual. Whereas the difference for yourself, Rob, is it's essentially based on the deal, right?
It is.
So therein lies the essential difference. Yeah,
it's the deal. I would argue, though, Nero, that I guess in your world, whilst it is about you, the individual, it's also about the structuring that you put around yourself in how you actually acquire your deals. Okay. Now, neither of us accountants, neither of us are lawyers. We can't say what to do. Okay.
Exactly. This is not financial advice.
We can't say what to do. As a matter of fact, I've got a little thing that actually says this is not financial advice, and I should throw it up right about now. Where is it? Here we go.
There we go.
There we go.
You can see it.
This is not advice. But one of the things that I've seen, I'm sure you've seen, where people try to, it's called, I guess, a couple of different ways. Your serviceability recycling or your debt recycling. I guess, without saying the kind of structure, what is the basic premise that they actually put behind it?
Essentially, what they're looking at is creating structures whereby the serviceability is based on a particular property. So you buy 37 Smith Street, you put it into this structure, cool. And then after it meets certain conditions, that's taken off the table. Now you go and buy 45 Jenny Street, and the first property you own is not considered in your serviceability, right? So that's the basic premise here, which in theory can allow people to have multiple properties. But as always, there's multiple complications. There are certainly additional costs and cash flow constraints that you need to consider. But yes, that is a possibility. I know personally, I've got clients who've sort of gone down this path once or twice and then decided it's just not worth the hassle and the stress and the complexity. So again, if you're looking at, if you're someone who's open to dealing with complexities, yeah, look, structuring could be something that might be something suitable to you. But if you're more, let's just keep this simple and easy, then you probably wouldn't go down that path. That's probably what I would be saying.
Yeah, I guess rephrasing what you just said is getting that one deal to be standalone and wash its own face. Okay.
Yeah.
And when it can stand alone and wash its own face, then when you go to the next deal, then they can look at that one in isolation and not have to. And so having a property that's close to neutrally geared at minimum is very advantageous to actually making that happen. But there are certain structures, again, can't tell you what they are, but we know what they are. There are certain structures where the serviceability element, if there is a shortfall, when you go to the next entity, it's not accounted for in this particular one.
Correct.
And at a very, very high level, it's because it's not you, the individual, that's on the loan, but rather it's the entity that's actually on the loan. And because it's the entity on the loan, it's the entity that's being assessed for its serviceability, not you, the individual.
That's correct.
And so when you go to the next, project, the next entity, you, the individual, are clean.
Yes. Essentially, in the eyes of the bank, correct. Yes. I mean, again, every lender does look at it differently, but certain lenders, that's exactly what they will do.
Yeah. So again, not advice, folks. But that helps people to grow past, I guess, one or two properties. And statistically, and I don't have the stats off the top of my head, but I'm pretty close in the accuracy of this. I guess about 92% of investors, and there's 1.2 million investors out there, about 92% of them don't get past property number 2.
Yep, that's about right.
Yeah, and it's largely because of that serviceability element that sits there.
Yeah, so serviceability is a big thing, and the other constraint is choosing the wrong asset type to invest in to begin with, right? Yeah. Because they get the first property wrong and go, I'll give it another go and hope it works, and without them getting the right help, they've probably gone inadvertently make the same mistake a second time, and then go, now I'm stuck, right? Yeah. And that seems to be a common thing that I've seen from so many people who are stuck. And those two properties, and generally the cases is they're not performing for them anyway, so they're stuck with two duds.
Yeah. So and maybe asset type is probably not the right way to phrase it, but they haven't been strategic in their decision in purchasing.
Yep.
They've gone, hey, I like this area.
Yes.
And not put any science into it. And they've gone,
yes,
I can see something that I like the look of. And without the science, they've not gone, well, I'm going to manufacture profit in my instance, or I'm going to, I guess, choose the timing of the market uplift in your instance. They've not been strategic in that purchase. Okay.
Yeah, absolutely.
And because they've not been strategic, they've not been able to get the benefit of either manufacturing or time manufacturing the growth. And so they can't then repurpose and recycle and go again. So
correct.
Super important, guys. I said it right at the very start. Get good at what you're doing. And if you're not good at what you're doing, then go and either educate yourself or partner with somebody who is actually doing the right thing and can actually guide you in the right area as to how to pick those areas.
100%. You cannot be making investing decisions, whichever pathway you go down, based on emotion. I know an area, I'm familiar with an area, whatever the case is. There has to be a strategy and a science behind it that you truly understand and can probably explain to an independent advisor. The thing of, I know that area isn't going to cut it in most instances, and the stats show that it doesn't.
Yeah. So, mate, so far we haven't had one fight. We're in agreement on everything.
Oops. I'm sure we'll find something to argue on soon, Rob.
Okay, so mate, the bazillion-dollar question. Whilst we're looking for different things in different places, I've always found that what you're looking for determines where you're going to find the solution.
Yeah.
So if I'm looking for a duplex, that is going to be a very, very different location to a 10-lot land subdivision.
Correct.
And I'm sure that the same goes for you. What you're looking for determines where you're going to find it. And there are times for both of us where a deal makes sense today in this market, and in 6 months' time, the same market, that deal does not make sense.
Yep.
So the hotspot is continually moving.
Yes, correct.
Continually moving.
Always. One of my key philosophies is that when you choose to buy will have a big impact on where you choose to buy, right? Because the markets, as you said, are continually moving. You can't just say, my friend bought a year ago and he's done well or she's done well, so I'm going to follow. You've got to have, again, this comes back to what we said earlier, you can't be making these sorts of emotional decisions on your investments. It's a fast track to the poorhouse in my eyes.
Yeah. So let's do a fast track to somewhere else, right? So
yes, exactly.
Now, the things that I'm looking for and the things that you're looking for in order to determine our hotspots are because we're trying to do different things. Okay.
That's correct.
As a property developer, we are, I guess, we're making the market. We are the ones that are actually going out there creating brand new things, hoping that people like you come and buy that off us. Okay. Now it may not be you particularly. It might be, I guess a homeowner, I guess an investor or whatever. I guess in that realm. But we have to be looking at where is the demand going, where are the people moving to, in order for us to go, I need to put an opportunity in front of them. Because if I don't know where the people are moving, then I'm putting a huge amount of risk in. I might find a perfectly developable site. I might get my feasibility right. I might be down to the dollar accurate in how I run my project. But if there's no demand, nobody's going to buy it. And if nobody buys it, I never get paid. Or if I do get paid, I don't get paid enough to actually make it worthwhile. So I've got to be moving. I've got to be very conscious of where people are going. So for me, that is my primary thing. What's your primary, I guess, the high level, your guiding light?
Yeah, for me, similar, but probably I'm looking for something a little bit different. I'm looking for really sales activity. I'm looking to see, are there buyers in this market, especially owner occupier? So ultimately what I'm looking for is similar to what you said. Are people moving into this area right now to buy and live, not in 5 years time or whatever else, right now? So I'm looking to see, is there more sales activity right now than there was 12 months ago? Are properties selling faster now than they were 12 months ago? I'm looking at open home queue. So, how many people are out the door, or is an open home sitting there and there's no one there? I'm really looking for that buying activity. That's my first indicator to really say, hey, is this an area that I want to then investigate going forwards?
So interesting you use the word indicator. Okay. I regularly talk about the difference between an indicator and a driver. So so an indicator is something that has already happened. So for that thing to happen, for that property to be on the market, there was a whole bunch of things that happened prior. So somebody had to decide they wanted to sell it. Then they had to go talk to a whole bunch of real estate agents. Then they had to prepare the property for market. Then they had to, prepare, go through a sales campaign and do open homes and maybe an auction campaign. Then you get to see the queue.
Yes, correct. Yes, absolutely.
So an indicator is always looking backwards in time at the market sentiment of somebody who made a decision for maybe 6 months ago to go, I'm thinking of selling.
Yes.
Right. I'm looking at drivers. I'm looking at what is going to move the market. So what is going to make someone want to think that they want to buy that in the future? So understanding where those people might want to go and why, and then have they started going there, right? So I'm not waiting for the queues to be lining up. I'm looking to be creating the queue, if that makes sense.
Yes, look, absolutely. And again, it's also because of, as you said, we're trying to do different things. We're actually trying to enter maybe even the same market, but at different times, right? Because of what we're trying to do. So I'm looking at, yes, indicators, but I look at what I call lead indicators versus lag indicators. And what the difference is, a lead indicator for me is this something that's going to indicate future price growth, right? That's what I'm looking for. A lag indicator, which is what I guess, most people are looking for, is how much have prices already risen? Well, it's irrelevant because it's risen. Yes, you're not going to get any of that capital growth, and past performance is never any kind of indicator about what's going to happen into the future, right? So I'm looking at lead indicators here.
Yeah, I agree, but even they still have something had to occur for that indicator to actually start to turn up.
Right? Exactly, something had to happen, and that's where I'm waiting to see what. Yes, I'm aware of what some of the things are that might have happened, but still, that's not enough for me to go and buy a property. I'm looking for, again, in my world, we're trying to minimize risk in terms of hitting that goal of getting that asset that's going to, or that property is going to rise in value so they can go and buy something else, right?
Yeah.
So therein lies probably the slight difference, I guess, and this might be where we finally do differ here, Rob, is what we're looking for, because our outcomes are also a little bit different in these scenarios.
Correct. So because you're trying to get the manufactured growth, whereas manufactured, you're trying to ride the growth, whereas
Yes.
I'm trying to manufacture the demand that will create the growth.
Yes.
Yeah.
Absolutely. Absolutely.
Yeah. So we have a point of difference. I'm not sure that it's not sure it's 1-0 or anything, but anyway. Okay, so now with that in mind, I look for 16 different drivers. Okay, so I do this on a regular basis, folks. If anyone wants to go and look at my YouTube channel, I run an event called Over the Horizon, where every 6 months or so I tell you where I see my 16 drivers. I literally did this Sunday session only a couple of weeks ago that actually demonstrated that. I also do twice a year a thing called Developer Launchpad, where I go into that and a whole bunch more and go into the science that sits in my head as to why I'm looking at those drivers. And I think irrespective of whether you're an investor or a developer, you touched on a really good point, which is we're going into the same markets, but at different points. And so if as an investor, you see what the developer's doing as a lead indicator, then that will give you some insights into what potentially is coming next.
Exactly. Absolutely. You're right. Which is because the different outcomes, the same market might be right for you today and not right for me, but tomorrow you might be done with it. And then that's perfect for us, right? For example. So and I guess it's always says, people say, is this a good area to buy in? I'm like, I have no clue, because I don't know what you're trying to achieve, right? And just as we've said, if you're a developer like yourself, Rob, might be great. As an investor, may not be, or vice versa. So you've really got to be clear. And it goes back to everything we've been saying here is you need to get good at your path, whatever your path is, and be clear on exactly what your investing strategy actually is before you start looking at locations.
Yeah, correct. And I guess if you're, in the investment space, part of the locations is going to be based on your budget and your ability to afford to purchase that property, based on the fact that you have to prove that 20 or 30-year debt. Whereas I can go into more open markets because I'm less concerned about my affordability and I'm more concerned about the profitability of the deal. So I can open myself up to broader markets, which gives me a level of competitive advantage.
Yep, absolutely. There is no doubt that, if you're going down this path, you've got more options on the table available to you. If you want, that's the path you want to go down. But again, as you said, you got to get good at this or get the right help from someone like yourself, Rob.
Yeah. Yep. So now, from a timing of the market, we've both said that we want to, where we want to enter. Are you looking to be the market pioneer, mate? Are you wanting to be the first in the area and set the trend? And
no, look, definitely not. Again, it's all about getting the maximum return for the minimum risk, right? That's what we're trying to do here. So therefore, I do not want to be the one who's buying first in an area expecting future growth, even if I do expect growth to come, because there's going to be a lot of pain along the way, right? Either I'm not going to see that growth for 6 months or 12 months, and I'm going to regret buying the property, or I may struggle to get the property rented. And, a lot of markets right now where a lot of people are expecting growth. And although I agree, I'm not entering those markets right now because it's taking some people, investors, 8 weeks, 10 weeks to get a tenant. And do you have the cash flow surplus to handle, handle that? So no, we're really looking for as close to a sure thing as possible. So, we've got sort of 13 drivers. Well, you've got 16. We've got 13, or 13 indicators rather, that we're looking at. And really, it is about saying, okay, does it meet pretty much 90%, if not 100% of them? how confident are we on a scale of 0 to 10 that this is going to work? And if it's not an 8.5, 9 out of 10, it might be a great market, but just not now, right? That's the key thing.
Yeah, and you just mentioned 13 indicators. I look at 16 drivers. Mate, keen to understand, I guess you don't have to list all 13, but just at a very high level. Now, I'm going to call one. I've made one technical mistake at the start of this show, folks. At the top of the screen, you'll see that it actually says open mic night. It is not open mic night. It is actually a Sunday session. I'm going to fix that right now. So for them...
there we go. Magic.
There you go. It says Sunday session now. That's the beauty of going live, folks. That's what happens. 13 indicators, mate. Just give me the categories that they go into.
Yeah.
You don't have to go into all 13 of them.
No,
what are the categories?
No. Number one, I said earlier on, is sales activity. Right? I want to see more. And when I say sales activity, I guess it's more accurate to say I'm looking for buying activity, right? And I'm really looking from buying activity, not from say developers or not from in investors. I'm looking for buying activities from owner occupiers, people who want to move into this particular area and buy. That's the first thing. And there's a number of indicators we look at there. That's primary for me. If I'm not seeing a high enough an increase in that or improvement in that, it's just not the right time for us to be buying. So that's really a big driver. Then only once we've got those ticked off, do I then start looking at things like, okay, well, what's the rental demand like in this area? Okay, because again, if you're an investor, and yes, most of our clients, we're buying for capital growth, but cash flow is going to be important to you, and especially at the start. And so can you get your property rented quickly, right? I don't want to be buying, like I said earlier on, in markets where people are being the first movers. Great. And sure, they may get the maximum uplift. I understand that. But can they handle 8 to 10 weeks of not getting a tenant, right? Most investors really don't want to be sort of, encountering those sorts of challenges. So we don't want that. So we want to see it. Can you get your property rented? Essentially, we're trying to say, what's the likelihood of you getting a property rented within 2 weeks or less? For us, 3 weeks is a long time. Right, that's really kind of how tightly we're looking at things. Then once we understand those, we're then looking at, all right, well, that's all great, but what about the other indicators that are going to indicate longevity of this area? So we're looking at infrastructure in investment, and we're looking at it from two perspectives there, Rob. Number one, yes, infrastructure project. Well, three perspectives actually. One is infrastructure that creates jobs in an area. So hospitals, for example, are great. Love following where new hospitals are being built. Number two, infrastructure that improves connectivity. So is it roads? Is it the train line? For people who live in Sydney, they're more than likely to be aware that once that new train line was actually construction started out to the northwest of Sydney, prices just went vertical, right? For a couple of years, it was just nuts because people could go out there and then still kind of commute to work in the city at that time. So connectivity is great. Thirdly, I'm also looking for what I call livability-based infrastructure. All right, so these are the things that make it more attractive for people to live in an area. So I'm talking shops, schools, parks. I'll often talk about aquatic centers, and people say, what is it, like an $8 million, $12 million aquatic center? How's that going to improve capital growth? And of course, it doesn't. But what it does go to show is that local council is either directly or indirectly investing in an area to make it more attractive for people to come and live in an area, right? So they're really sort of the big buckets that we're looking at. And the final one, it's always economic strength and economic diversity, right? I want to really check out what's the gross regional product, the GRP, how fast is that growing? How does that compare with the state average economic output? To kind of say, well, are we buying an area where there's lots of money being generated? Because in Australia, whenever there's a lot of money sloshing around local economy, it finds its way into real estate. That's just what we do as Aussies, right? So that's always very important. So there's sort of the big buckets that we look at, Rob.
Well, a lot of people don't actually realize this, mate, but the reason why it does that is real estate is actually the second largest employer of any industry that we've got.
Yes.
So, and it comes from, I guess, a combination of, we've got agents selling, we've got, I guess, developers doing things, we've got builders building things, we've got finance people financing things, we've got, when you actually add everything up in the industry, we've got chippies doing work, we've got, I guess the building and construction or real estate in total is the second largest employer. So And
Yep.
so, yes, we are property mad
Yes.
for a reason.
And properties, we're such a property-centric economy, right? And so that's why again, when people are worried about what property prices are going to do, it's, if you look throughout history, the government does something to either directly or indirectly keep property prices rising. It underpins our very basic economy. So it is a very, well, I think a much lower risk investment vehicle, whichever pathway you choose, compared to maybe some of the other assets that people could choose.
Yeah, I would actually second that comment that I guess whenever there is any stress on the market at all, the government will step in with some form of government incentive to kickstart the the industry. I guess the perfect example is after COVID, they printed the 25K building bonus and things like that. So now sometimes their intentions are well-intentioned, but they don't execute well. But that's it.
That's a different conversation, I think. We're
not going to go into that. But yeah. So thank you, mate. A lot of those things are, I guess, very similar to what we look at. There's now 16 drivers. They fall into 4 primary categories. So infrastructure spending or government incentives is really, and infrastructure is a huge one in that. That creates jobs in an area. Jobs in an area means people are spending money in the area, which means that I guess the businesses in that area are benefiting, so they start to employ more people. So then those people start spending. So it creates demand. It's called trickle down economics. When you understand how that works, that is going to start to attract people into the area as soon as huge infrastructure is being spent. So we're looking at where those huge infrastructure projects are going. You mentioned hospitals, but there's roads and trail networks and a whole bunch more. But where the government is spending billions of dollars is the clue, folks. Then there's, so they're long-term government spends, but then there's also short-term government spends. So is there a short-term bonus? So is there a first homeowners grant that's been doubled at the moment? Is there a I guess a homeowner's grant guarantee that means you don't need, you can do a 5% deposit and have a 95% loan without a homeowner's warranty insurance. Can you do does the building bonus start to come in? Do you get exemptions for your stamp duty? Now, most of those, it's a 3-month, 6-month, 12-month window where they open that up just to kickstart something in the area. And you'll find some of that happens at the federal level, some of that happens at the local level, I guess because they're trying to kickstart different parts of the economy. So I guess government spending is category number 1. Population growth is probably, I guess, the next biggest one. So you've got births, deaths, and marriages. That's neutral. We're dying off as quick as we're growing, so that's not. You've got intrastate migration. So how many people are leaving the city and going to regional? How many people are leaving regional, coming to the city? A lot of that happened in COVID. A lot of people left, I guess, Melbourne and Sydney in particular, and went out regional. And that's kind of stopped now. There's interstate migration. So how many people are leaving one city and moving to another city? There are hordes of people leaving Sydney at the moment, hordes of them. And there's quite a few leaving Melbourne too, right? Quite a few. And so when we look at that, we go, well, those 2 cities have a negative, but those people are landing somewhere. So somewhere is getting a positive, right? And so the places that were getting, I guess, the positives, Southeast Queensland and Perth was getting huge, which is why Perth just went through its giant boom. And then the last one is international migration. And this is the one that is probably the biggest mover of all of them. So international migration is overcompensating for all of the other 3 combined. Okay.
Agreed.
And so I guess where the international migrants are going, if you were looking at a leading indicator, that is the leading indicator. Okay. That is a massive leading indicator. As a matter of fact, it's a 2-year leading indicator. 2 years. Okay.
Wow.
The reason why it's a 2-year leading indicator is because when they come to Australia, they are not yet Australian residents, so they cannot get a loan. So they have to go into the rental market. So most people are looking at the rental market as the leading indicator, but that's actually a lag based on the international migration. So if you know where the migrants are going, you know that the rents are going to go up. Okay. So they all go into the rental market first. And then 2 years later, they start to get residency. Then they start to want to leave the rental market and start to want to buy. So it's a 2-year leading indicator about demand that's coming. Now, we've just had the biggest population growth on record. So last year, 518,000 people came to Australia. So when you know where they went, folks, that's going to give you some clues.
Very much so.
That's going to give you some clues. Then this year we're on track for about 460,000 people, and we're projected to have around that 450 a year for the next 5 years. So that is by far our biggest driver. Then we've got in our space, property development space, we're looking at supply and demand. How many development applications, that get approved by council? So that is the potential for supply, but it's not actual supply. How many of those then get converted into building commencements? So when they actually go into a building commencement, that is the actual supply. So when we look at the difference between potential supply and actual production and what actually goes in, where there's always going to be, not every development application gets constructed, but when there's no surplus, no slack in the system, then there's a huge pressure that as soon as you do a development application, it's going to be wanted straight away. And so we're looking at those supply and demand dynamics. And the last one we're looking at is housing affordability. So the affordability side of things. And so unemployment rates, can't borrow if you haven't got a job, right? We're looking at inflation. So if inflation is high, that means that the cost of living is up, which means we have no surplus cash. We have no ability to spend what we are actually earning, irrespective of if we have a job. Interest rates, if interest rates are too high, then we're just treading water, I guess, covering our costs, and we don't have surplus cash, and our borrowing capacity is much, much lower. And so then the people that then dictate that is the Reserve Bank of Australia and what they call forward projections, and APRA, who we don't hear much about, but APRA, I guess, are the fine tuning of, hey, I want to have one market tweak a little bit harder than another. So RBA is the entire industry, the entire economy, whereas APRA is fine tuning, hey, I just want the investment market to do better, or I just want the owner occupier to do better. So APRA does the fine tuning. So they're the 16 areas that we look at in the 4 categories in particular. So similar-ish things, but they're telling me, where is the market going? Now, knowing what you know, my friend, and what I've just kind of led to people, where are the people starting to go? Where's the next hotspot for you?
Look, absolutely right. And I think just a couple of things there, like, when you talked about the short-term government spending. So a good example is when the South Australian government came out and said that from July 1st last year, they're increasing the first homeowner grant to whatever, $750,000, and stamp duty exempt and whatever it was. And so it was very clear that there were a lot of other fundamentals, but anybody who bought before June 30 last year was going to see a significant, quick uplift in the subsequent 6 months. And that's exactly what happened, right? Because all the other fundamentals there, but now this short-term government spend was like, it's like the accelerant on the fire. It just kind of took things up for another notch. Short term, you're not going to see that sort of growth again over another 6 months, and that's why people are saying something like Adelaide is flattening out. But it's not flattening out because the fundamentals have changed. It's just flattening out because the impact of that short-term government initiative are petering out. right? So again, understanding these things make a big difference. I think in terms of where we're looking to buy for clients, I still think there's lots of indicators pointing towards regional Queensland still being very strong. Okay, yes, it's had a really good run, but they're not building enough properties there, and people are still moving. So again, I am very much reliant on fundamental economics. I've got an economics background, so when there's people moving into an area and they're not building enough properties, well, unless the laws of economics break, prices will rise. So I'm very big on regional Queensland. As I said, I really like Adelaide. I like Brisbane. I think finally Sydney, after probably doing well and then having sort of a 12-month kind of break from prices really rising and being a bit flat, I think it's going to come online, because even though it's our most expensive market, that also means that it is the most sensitive to interest rate reductions. And so as interest rates start to fall, that's going to be now the key thing that will then drive prices up, because there's a huge shortage of property in Sydney. So it's not just interest rates, it's the other factors as well. But the interest rate fall is what will trigger Sydney to go. And look, Melbourne, we've spoken a couple of times already. It's definitely a market that we're watching. I think there are certain areas that are certainly going to start rising. It's a matter of time for Melbourne. For me, I'm not sure it's necessarily right for most people, but it's definitely a wait and watch. I'd be very surprised if Melbourne doesn't do some amazing things, starting, maybe as soon as the next few months, but definitely from, sort of later this year, that's for sure.
Yeah, I'm in agreement in seeing Melbourne. I'm looking at it from a very counter-cyclical type thing to go. All the fundamentals are pointing in the right direction from a property development perspective. All those 16 drivers are all saying to the moon, with the exception of people leaving the state who are already been living there because they're no longer happy with their government being broke. But there's enough international migrants, I guess, covering that to say that they're still moving forward at a great rate of knots. So I see Melbourne a little bit slower than everywhere else, a little bit slower than everywhere else. But I think the potential there is much higher than everywhere else, because you've got an ability to get in, I guess, while the market is at a lull, and there's not much excitement in there. I think you've got a lot of chance to actually start to pick up some really good bargains in there, both from an investment perspective and a property development perspective.
Absolutely, and I think the value proposition is very strong there as well. Melbourne is our second biggest capital city, but the price difference between Sydney and Melbourne is astonishing, right? You can still get something decent for under $750,000 in Melbourne, and relatively close to CBD. Sydney's $750,000. Unless you want an apartment, even then you might struggle. You're probably getting a tin shed somewhere, right? It's just not happening. So the value proposition is also very strong, and that's something else that we look at, and that's what I think is driving a lot of people to potentially move from Sydney to Melbourne. We are seeing that more than I've seen in the past. It used to be in the past, people from Sydney, if they're moving to Brisbane. That would be the kind of the key thing. But now the Brisbane prices are, definitely no longer cheap. I mean, they're cheaper than Sydney, but you wouldn't call them cheap anymore. I am seeing Melbourne coming online. So a lot of positive indicators there. But again, you've just got to look into a bit more. But yeah, I like Melbourne as a long-term player, but I agree with you, Rob. I think it's going to be a little slow to begin with before it really heats up.
Yeah, but I'm already seeing a lot of buyers agents looking at Melbourne, and a whole bunch of activity starting to occur. And as soon as the I guess we'll call it the hype of a lot of buyers agents start pushing there, then that creates more hype, and then when it becomes a self-fulfilling prophecy at some point, and then it just starts to take off. And I don't think it. I think we've probably got a 3 to 6 month window before that actually kicks into gear. But yeah, I see it happening.
Absolutely.
Mate, overall, I'm disappointed. There's no blood on the floor. There's nobody.
Whoopsies.
Yeah.
Yep.
So we've largely got very, very similar philosophies in everything that we do. We're just executing in a very, very different way. So, mate, firstly, thank you very much for your time today in actually going through, I guess your investment process and how you are looking for, I guess, deals for your clients and how you're picking your hotspots and that sort of thing. Have you got any parting thoughts and parting gestures for, I guess, our audience today, mate?
I think the worst thing that most people could do with where the market is sitting is, if you can afford to buy something in the right areas, choosing not to buy. I think taking a wait and see approach is going to result in a wait and regret approach for most people. I really do believe that with the housing shortage that we have right now, yes, affordability is an issue. But it's not going to get better. It's only going to get worse, because prices will continue to rise, driven by the supply and demand, or the supply shortages that we have across multiple markets. So I'm trying to buy again as soon as possible. Personally, we've got a lot of our clients returning to buy again. I just think that if you sit on the sidelines, you're just going to regret it. Really, that's all I can say. But definitely make sure you got the right plan, get the right guidance, study it. It's not something you do an emotional thing, but take action now is what I'd be saying.
Yeah, I would concur with that, but I would actually, I guess, add to that to say, make sure it's the right action.
Yes.
I guess make sure that it's informed and educated and you know what you're doing. As we touched on right at the very start of the show, be good at what you do and everything will work from there. So if you are not yet good at that, there's only two solutions to that. Well, three, you can fumble and work it out, but it's going to take you a while to get good. Not my preferred approach. No. Two, educate yourself and fast track that process. Or three, I guess, work with someone like yourself who is already experienced in that place and can actually take you there much, much faster while you backfill your education underneath the covers. So
exactly.
So my guidance, folks, equally. The time to act is now. The time to actually get yourself onto the dance floor is now, because we are in for what I think is going to be one of the biggest property booms over the next 2 to 3 years that I've seen in my 37 years in property at all. So I guess we'll go back and watch this recording in 3 years' time and see if I'm right.
I think you will be, though. I think we're going to see a significant price uplift. Again, it's just saying, just don't do anything blindly, right? Don't, make sure, if as you said, Rob, make sure it's the right action. Make sure you have a science behind it, whatever strategy you're choosing, so you do take the right action. And I'm sure in 2 or 3 years' time, you'll be sitting back going, yeah, these were some of the best financial decisions I could have made.
Yeah, very good, mate. Thank you very much for coming on. Folks, we have people just like Nero, I guess, and other industry experts coming to our events all the way around the country. So not only do we run these Sunday sessions, but we run events in Brisbane, Sydney, Melbourne, and Adelaide. We've got town planners, civil engineers, architects, property lawyers, and a whole bunch of people also sharing their real deals. Make sure that you come to one of those upcoming events. Mate, I'm going to say thank you again for your time.
A pleasure,
Rob. Folks, till next time, bye for now.
Bye-bye.